Hi guys and welcome back to my channel Pips on Profit, and in this current series we're teaching forex trading for every beginner, and in this series we're going to be teaching you how to become a profitable forex trader. We're going to be taking you from beginner level even to an intermediate level and soon an advanced or a professional level as a forex trader. So if you follow through with this series, you should be able to become an intermediate trader by the end of this series. I promise you that. Okay, so in this video, we're going to be talking about different types of forex analysis. All right, so we have 5 different types of forex analysis, and we're going to be looking at them right away. Now, for the first type of forex analysis, it's called the fundamental analysis. And in the fundamental analysis, we are examining economic, social, and political factors that could affect currency values. Okay, so when you're trading any particular currency, you need to run some fundamental analysis on it. And when you're running fundamental analysis on that particular currency or that particular currency pair, you're trying to examine the economic, social, or political factors that could affect that particular currency. All right, and we have a few websites where we're able to get interpretation of fundamental analysis. I'm going to drop a link of that in the description of this video. So you're going to see description of in the description of this video. You're going to see links to a few websites where we have commentaries and we have calendars of for fundamental analysis. All right, and then the tools that we use in this fundamental analysis are economic indicators, central bank decisions, and geopolitical events. Now, economic indicators could be the things that we measure to know if there is growth or if there is inflation in an economy. All right, if there is growth or there is inflation in an economy. And a few of these indicators could be the CPI, Consumer Price Index, the PPI, which is Producers Price Index. We have the GDP, which is Gross Domestic Product of a particular currency, all right, of a particular country. So when we are measuring economic indicators of a particular currency, we use these things. We also use the employment and unemployment rates of these currencies to indicate if if the particular currency is doing well or if it's not doing well. Now, when these things are measured, we use them to know if we should be buying or selling a particular currency or if we should be staying out. Okay, so those are economic indicators. There are so many others, but these are the most common economic indicators for or the most basic economic indicators of any currency. We also have central bank decisions, which has to do with interest rates hike or interest rates cut. Okay, so when there is a hike in interest rates, investors are attracted to that currency pair and or that particular currency, and then we see that currency becoming bullish. When there is a cut in interest rate, investors are no longer interested in that currency or that particular currency that is being traded. So we begin to see bearishness in that currency. Okay, so central bank decisions are majorly around interest rates hike or interest rates cut. All right. Then we also have geopolitical events, which could be wars or economic decisions around trades and investments in a particular currency, right? For instance, when we had the Ukraine and Russian war, there was influence, we had impacts of that war on various currencies that are traded within that level. We have impact on it on the Russian currency and on the Ukrainian currency, okay? Also, when we had the Israel-Hamas war, there was impact on Israeli currency and the Palestinian currency. Okay, so similarly, when we had the Chinese-Taiwanese tension, we had influence in the Chinese currency and the Taiwanese currency. So when we had geopolitical events like this, or when we have collaborations within countries, we tend to see an impact in their currencies. Okay, so this is what we are doing when we are doing our fundamental analysis. This is what we're looking out for when we're doing our fundamental analysis. We're looking at the impact of economic events, central bank decisions, or geopolitical events on a particular currency. So we know if we should go bullish on that currency or if we should go bearish on that particular currency. All right. So the objective of every fundamental analysis is to determine the intrinsic value of the currency. Okay. So that is for fundamental analysis. Now, over to the next type of analysis. This is called the technical analysis. And in the technical analysis, we are analyzing the historical price data and chart patterns to predict future price movement. So we're looking at what has happened in the past to predict what will happen in the future. We're looking at chart patterns, we're looking at price movements that has happened in the past, and then we're predicting that similar things are going to happen in the future. And we have a few tools that we use for that. Part of the tools obviously is a chart, and then we also have trend lines, we have technical indicators, and we have candlestick patterns. All right. So these are tools that we use to do our technical analysis. We use them to analyze what has happened in the past and then to forecast when those kind of things are going to happen in the future. And the objective is to identify trends, to identify reversals, and to identify potential entries and exit points. So when we are able to identify trends, we now know how to take advantage of it. We know how to enter and when to exit. We also use it to identify reversals of these trends. Okay, so this is what we do when we talk about technical analysis. All right, so the next type of analysis is called the sentiment analysis. And in the sentiment analysis, we are accessing or we are assessing market sentiment to gauge the mood of traders towards a particular currency. So if you're trading a particular currency, you want to see what traders in other countries or traders who are trading other currency pairs are thinking about the particular currency that you're trading. For instance, if you're trading the US dollar, and then you're trading it against the Japanese yen. You're trading the US dollar against the Japanese yen. You would want to also know what people who are trading the US dollar against the Canadian dollar are thinking. You also want to know what those who are trading the US dollar against the Chinese yuan are thinking. All right. When you do this kind of analysis, it's called a sentiment analysis. You want to know what other people who are trading similar currency with you are also thinking. So if they are going bullish, that means they are going bullish on the dollar. That means on your own end, you too should be going bullish on the dollar. And how we are confirming this kind of sentiment is that the banks and bigger institutions are the ones trading this market alongside you and I, who are retail traders. So we want to know what they are doing or what they are thinking so that we trade alongside with them and profit alongside with them. Okay. Now, we also have various tools that we use to do our sentiment analysis, one of which is the COT, which is called Commitment of Traders. All right, we have Commitment of Traders report. So in this Commitment of Traders report, we tend to see where banks are putting their money on, the currencies that they are trading, whether they are buying or whether they are selling, and we join them in doing so. We also have social media sentiments and we have market positioning. And the objective of sentiment analysis is to understand whether traders are bullish, bearish, or neutral on a particular currency pair. All right, so that we'll know what to do alongside those traders. Okay. Now, on to the next type of analysis. It is called the intermarket analysis. And in intermarket analysis, we are examining relationships between different financial markets to make predictions. Okay, so we are relating different financial markets. For instance, you can be trading stocks. You want to know the relationship between stocks and bonds. Are they correlating or are they diverging? If there is a divergence between a particular stock and a particular bond, whenever they are diverging, it means that they are going in the right direction. Whenever they are correlating, it means it's going in the opposite direction. Okay. Now, we have various tools for doing intermarket analysis, and these tools are when we compare commodities, for instance, like sugar, barley, oil, and the likes. And then we have stocks like the Tesla stocks, Facebook stocks, Amazon. We also have a compilation of these stocks in like the Nasdaq. We have the Dow Jones. We have the S&P. We have the Nikkei. We have so many other different types of stocks. We also have the bonds, which are like the 10-year US bond, the 30-year US bond, the 5-year US bond. We have the 10-year Japanese bond. We have the UK gilts, and we have the euro bonds as well. So we have various types of bonds. Now, when you're doing intermarket analysis, you're correlating, or we're trying to look for correlation or divergence between currency pairs and stocks, or currency pairs and bonds, or currency pairs and commodities, or bonds and stocks and the likes of them. We're trying to look at these different markets because all these stocks, bonds, commodities and currencies, they are all different markets. So we're trying to look if there is a correlation between these markets. If there is a correlation, that means we're going to be going in line with that correlation. For instance, if a particular currency pair is having a correlation with a particular stock, that means when the currency pair is buying, that stock is also buying. That means we should continue in that direction. If one is doing the opposite of the other, then we should stay off. Okay? That is for correlation. So for instance, if USD JPY is an example, not a practical term, all right? So if USD JPY, for instance, is buying and we have maybe NASDAQ 100 selling, sorry, if USD JPY is buying and we have Nasdaq buying as a correlation or as a correlating market. Now, whenever we see Nasdaq selling and USD JPY buying, that means we should stay off the market. Something fishy is going on. We should only buy when the two of them are buying or sell when the two of them are selling because there's a correlation between the two of them. And then we also have diverging markets. For instance, if Euro USD is buying and then we have a particular Euro bond selling, now that is a divergence. If their nature is a diverging nature, if one of them is buying, the other should be selling. If we see the two of them buying, that means we should stay off, or we see the both of them selling, we should stay off. We need to see one doing the opposite of the other. Okay, so that is intermarket analysis. So there are various markets that are correlating and diverging. We're going to shoot videos on that in some other series. But for this series, we just want you to know the meaning and the tools to use for various types of analysis. We also have another type of analysis which is called the quantitative analysis. And for the quantitative analysis, we are using mathematical models and statistical techniques to analyze currency movements. There are various machines and algorithms that are built to do this. Okay, so various companies have their own algorithms, they have their models that they have built to be able to do this. And tools that we use are algorithms, like I mentioned, statistical models, and quantitative indicators. They are used to mathematically find out the movements of price in previous times and then predict how these are going to be done in future. This is like a machine-based technical analysis. Okay, so using using a machine to run technical analysis to study the past and predict the future. That is what we do in quantitative analysis. But these machines are mathematically driven. All right, they are using mathematical models and statistical techniques to drive these machines or these algorithms. Okay, and the objective of this is to develop data driven trading strategies based on mathematical patterns. Okay, so these are the various types of analysis that are being done. All right, so hope this video was helpful. If it was, click on the like button, and if you've not subscribed, kindly subscribe to this channel so that you can get more videos like this in coming times. Okay, and make sure you share this video with your friends who are aspiring traders or who are beginner traders so that they will get a soft landing to this career or to this world of Forex trading. All right, until we meet again in the next video, I wish you good luck and good trading. Cheers and God bless, guys.